thanks a lot for joining us. Of course, we'll talk to you next week now. For now, we have our next guest joining us, Sandeep Shah, Managing Partner at MOPWM Private Wealth, is now joining us. Sandeep, good afternoon. So it's been a strong market over the last few days. We've seen the market really surprise on the upside. Now at 11,400, how's the risk reward stacking up? Are you telling your clients to take some money off, or is this a market where you're still fully invested?
Well, actually, this rally has not been surprising at all. In fact, the last time I was on this particular show, I had given you a target of 11,400 to 600. And incidentally, we've actually hit somewhere around 11,450 or something. And we've dipped a little. The point is that obviously what we have seen is that, we've seen a synchronized global bull market in all asset classes, whether it's debt, equity, gold, commodities, or at least we've seen a fairly sharp rally in some of these, even if we don't have a full-fledged bull market in all of these. So I maintain my view that, while shorter term, including large caps, especially in large caps, it looks like valuations of at least a lot of stocks and sectors look fully valued. There are still some pockets of reasonable or undervaluation as well, because the averages always hide more than they reveal. And from that perspective, I maintain my view that we can invest about 50% of fresh flows at current levels, and the rest should be staggered over the next 3 to 6 months. Because remember that longer term equity valuations and the right valuations to look for longer term is not a P ratio, which is very volatile, but market cap to GDP and price to book. And all of these are still around long-term averages. They're not significantly below the long-term average as it was in March and April. And so from that perspective, what we've also seen is that if you were to look at, put all these valuation parameters together, which is price to book and PE and everything, there is more than a 50% probability of double-digit positive CAGR returns over the next 3 years. So that definitely makes a case for staying invested. And just to give you a sense of the kind of liquidity that, we all know that all balance sheets of global central banks have increased dramatically. But, just to put it in perspective, the broad money velocity in 2008 was up to 10% increase. And this time around, it's between 10 to 30% across different countries. So from that perspective, yes, longer term markets, equities are still attractive.
Okay, equities are attractive, and you know what? Although the headline index may be indicating a fall, there is so much of action beneath the surface. Just look at the moves here. Minda Industries in the auto ancillary space is now up over 8%. Sun TV has been the biggest mover in the last 2 days. It's up almost about 8%. And these packaging companies have just taken it away. So SL Propack is the one that's gaining some more ground now, up about 5%. Sandeep, hi, good afternoon. I wanted your thoughts on these packaging companies, whether it's Uflex, Cosmo Films, Polyplex, SRF, they've all gained about 25 to 80% this year. You think the story is still to play out, and would you advise putting, some money to work here?
So these are, extremely cyclical businesses and have a strong play on commodity prices as well. So you're dealing with actually two variables which can change dramatically. So unless and until you're a seasoned professional investor who's able to track raw material prices, is able to track the finished product prices, change in demand supply, what's happening at the customer end, these are really for those kind of investors. For I think the majority of retail or non-institutional investors, I think they would be better suited to stay invested in long-term growth secular stories rather than some of these plays, unless they're there in that sector or they have a inside view or a ringside view of what's happening in the space.
Okay, that's on packaging, of course. These are cyclical plays, as Sandeep is explaining. Sandeep, power is making a big comeback. It's a space which has destroyed so much wealth over the last many years, whether it's private companies or public companies. But names like Tata Power, NTPC, are you interested in buying any of these stocks now?
Actually, that's a very interesting question, because this is a very interesting space, given the regulatory issues, given the problems that have plagued the sector. At the same point of time, the extreme importance of the sector. Also the fact that this does have some very good companies as well. If I were to break them up into, look at some of the PSU power companies, some of them are very attractive, and we've actually seen some of them report good numbers as well. The valuations are at close to historical lows. Some of them are trading below price to book with reasonable ROEs and giving you a 5 to 7% dividend yield. So I think that at some point of time, there is always this reversion to mean trade, in the sense that there are sectors which are beaten down and stay beaten down for a period of time, and at some point of time they do bounce back. Perhaps we are on the cusp of one such time for power. While I can't speak so confidently about the private sector companies, because the debt on some of the balance sheets is a bigger concern. But incidentally, we've also, as our institutional equity research has also upgraded some of these private power companies, and because a lot of them, even on the private sector side, there seems to be a clear game plan for actually bringing debt down and managing the balance sheet better. And this downturn has been around for a while, so it's actually giving companies time to actually rework their game plan. So positive on the PSU power utilities, and marginally positive on some of the private sector power companies, very selectively.
Okay. I have to ask you about Z Entertainment, because this is one stock that has eroded not just investor wealth but investor confidence as well over the past 1 year. But now things are changing, right? I mean, they're promising more disclosures. Would you change your view here as well? I mean, how are you approaching it?
So I think that obviously there is this huge a lot of the media stock valuations are obviously factoring in what's happening in the OTT space and the migration there. Having said that, I think companies which can actually, even if who can actually clean up their corporate governance, at least in terms of perception and what investors want them to do, and and they're able to actually, some of these businesses do have a reasonably strong franchise, and they do have some loyal audience as well. And however, remember that media is a late cyclical. So while we're waiting to see a post-COVID era and then recovery in the economy, please remember that you might see some reversion to mean in terms of valuations for some of these companies, especially if some of these specific issues affecting these companies are no longer there, and the market simply, reprices it to a more normal valuation. That would give you a one-time pop. But for an investor who's looking for longer-term returns, we should remember that media is a late cyclical. So we might want to wait and see the economy recover before we actually go full blast into the media sector.
Reading your note in which you're bullish on rural plays, but that's a large space. So if you could narrow it down, what part of rural theme would you play on?
So we would look at consumer. We could selectively look at auto in that space as well. We could very selectively. But there, when I say selectively, I mean probably there's just one or two rural-focused NBFCs we could look at, and I'm not yet referring to the microfinance companies, because on the microfinance side, we want to be certain about the accounting and other norms, which tends to vary from company to company. So that's the broad view.
Okay. I wanted your view on any of these. We've been talking about these agrochemical companies, specialty chemical companies. My colleague is just indicating to us that some of these names like IG Petrochemical, Thirumalai Chemicals have been rising quite a bit. In fact, both these stocks are up about 12 to 20% because demand is recovering in the paints and the plasticizer space that they supply to. Any of these themes that you like?
So this is like a replay of the earlier conversation we just had right now, because while paints has shown strong secular growth, the profitability of some of the companies that you mentioned is also very strongly linked to their raw material prices, and not to the price of paints, but the price of the finished product that they make, which goes into paints, and which is again, of course, has some of these products have a linkage to oil prices as well. And so to that extent, my advice would remain the same, that continue to, for retail or non-institutional investors, continue to stay focused on, the broader themes, the bigger themes, the long-term plays, and at the same point of time, if you have the ability and the understanding, and you're able to spend time analyzing these businesses, I'm sure they can make money for you. But that's not something that we're advising our clients.
Okay, Sandeep, we'll leave it there today. Thanks a lot for joining us. Good talking to you. Well, while we were talking, we should have spoken about it. The 3 p.m. move, there's absolutely nothing on that front. So it looks like perhaps for today